Hello and welcome to our YouTube channel, The Patient Swing Trader, video tutorial session number 2. Today, we will define and discuss the most common investment tools, including stocks, ETFs, mutual funds, and bonds. We will highlight which of these tools would be ideal for a patient swing trader. Disclaimer: it is important to emphasize that the tutorial video series on swing trading is for educational and entertainment purposes only. The information and strategies presented are not intended to be construed as investment advice or recommendations. As a viewer, you should always seek professional financial counsel before making any investment decisions. Remember that all investments carry risk, and it is essential to only invest funds that you can afford to lose without affecting your financial stability. Additionally, it is crucial to keep in mind that investing should be a long-term strategy, and any short-term gains should not be the sole focus of your investment activities. Always consider your financial goals, risk tolerance, and time horizon before making any investment decisions. So, let's use this video series as an opportunity to learn and improve our knowledge of swing trading, but always remember to invest wisely and responsibly. Now that we have covered the rules, let us proceed with the definitions of the different classes of investment assets. So, what is a stock? A stock, also known as a share or equity, is a unit of ownership in a publicly traded company. When you purchase a stock, you essentially become a shareholder in that company, giving you a portion of the ownership and potentially entitling you to certain rights such as voting on company decisions and receiving dividends. For example, Apple Inc. is a publicly traded company on the Nasdaq Stock Exchange under the ticker symbol AAPL. If you were to purchase shares of AAPL stock, you would become a part owner of the company and have a stake in its success. As Apple continues to innovate and release new products, its stock price may increase, potentially resulting in a profit for shareholders who purchase the stock at a lower price. Similarly, Tesla Inc. is a publicly traded company on the Nasdaq Stock Exchange under the ticker symbol TSLA. If you were to purchase shares of TSLA stock, you would become a part owner of the company and have a stake in its success. As Tesla continues to disrupt the automotive industry with its electric vehicles and expand into other areas such as renewable energy, its stock price may increase, potentially resulting in a profit for shareholders who purchase the stock at a lower price. What is an ETF? An exchange-traded fund, or ETF, is a type of investment fund that tracks the performance of an underlying index or group of assets, such as stocks, bonds, commodities, or currencies. ETFs trade like individual stocks on an exchange, and their prices fluctuate throughout the day as investors buy and sell shares. For example, the Vanguard MGK is an ETF that seeks to track the performance of the CRSP US Mega Cap Growth Index. The index includes large-cap US companies that exhibit growth characteristics, such as high earnings growth, strong price momentum, and low volatility. The ETF holds a diversified portfolio of over 280 stocks, with top holdings including technology giants Apple, Microsoft, Amazon, and Facebook. As of September 2021, the fund has net assets of over $43 billion and has an expense ratio of 0.07%. SCHD, on the other hand, is an ETF that tracks the performance of the Dow Jones US Dividend 100 Index. The index includes 100 high-quality US companies that have a history of paying dividends, with a focus on sustainability and growth of dividends over time. The ETF holds a diversified portfolio of large-cap stocks across multiple sectors, with top holdings including Microsoft, Johnson & Johnson, Procter & Gamble, and Coca-Cola. As of September 2021, the fund has net assets of over $29 billion and has an expense ratio of 0.06%. Both Vanguard MGK and SCHD are examples of ETFs that provide investors with exposure to different segments of the US equity market. While MGK focuses on growth-oriented large-cap stocks, SCHD emphasizes companies that have a track record of paying and increasing dividends over time. What are mutual funds? Mutual funds are investment vehicles that pull money from individual investors to purchase a diversified portfolio of stocks, bonds, or other securities. The mutual fund is managed by a professional fund manager who invests the money according to the fund's objective and strategy. One major difference between mutual funds and stocks or ETFs is the level of diversification. While stocks or ETFs typically invest in a single asset class or industry sector, mutual funds provide investors with exposure to a broad range of securities across multiple asset classes. For example, the Vanguard 500 Index Fund, VFINX, is a mutual fund that seeks to replicate the performance of the S&P 500 index by investing in the 500 largest publicly traded companies in the United States. This fund provides investors with exposure to a diversified portfolio of large-cap stocks across a variety of sectors. Another example of a mutual fund is the PIMCO Total Return Fund, PTTRX, which invests primarily in fixed-income securities such as bonds. This fund aims to provide investors with a combination of income and capital appreciation through a diversified portfolio of high-quality bonds. In contrast, a stock such as Apple Inc., AAPL, represents ownership in a single company. While Apple has a diverse range of products and services, it still represents exposure to a single industry sector and company. Similarly, an ETF such as the SPDR S&P 500 ETF Trust, SPY, tracks the performance of the S&P 500 index, but it is still limited to a single asset class, large-cap U.S. stocks, and does not provide the same level of diversification as a mutual fund. Another example of an ETF is the Schwab U.S. Dividend Equity ETF, SCHD, which invests in high-quality dividend-paying U.S. stocks across a variety of sectors. While this ETF provides some diversification, it is still limited to a single asset class, U.S. equities, and does not offer the same level of diversification as a mutual fund. Overall, mutual funds offer investors a way to achieve broad diversification across multiple asset classes and sectors, making them a suitable investment option for those seeking a well-rounded portfolio. What is a bond? A bond is a type of debt security where an investor loans money to a company or government entity in exchange for regular interest payments and the return of the principal amount at maturity. Bonds are different from stocks and ETFs as they represent a fixed income investment and do not represent ownership in a company. One example of a corporate bond is the General Electric County 4.375% January 15, 2025 bond, CUSIP 369604CX6. This bond has a fixed coupon rate of 4.375% and matures on January 15, 2025. Investors who hold this bond will receive regular interest payments until the bond matures, at which point they will receive the face value of the bond. Another example of a bond is the United States Treasury 10-year note, CUSIP 91282 CAV3. This is a government bond issued by the United States Treasury and has a fixed interest rate of 1.5% per year. The bond matures on February 15, 2031. And investors who hold this bond will receive regular interest payments until it matures, at which point they will receive the face value of the bond. In contrast, stocks represent ownership in a company and offer the potential for capital appreciation and dividends. Overall, bonds are different from other investment tools as they represent a fixed income investment and do not represent ownership in a company. Bonds can offer a reliable source of income for investors, and they can be less volatile than stocks or ETFs, making them a popular choice for risk-averse investors. So, which of these assets is ideal and can be used for swing trading? Based on the nature of the swing trading, stocks with high liquidity and volatility are typically preferred for swing trading. Therefore, stocks that are actively traded, have a relatively high trading volume and show consistent price movements are ideal for swing trading. Additionally, it is important to look at the fundamental and technical analysis of the stock to assess its potential for short-term gains. From the lists provided earlier, some stocks that could be considered for swing trading include Apple Inc., AAPL, Tesla Inc., TSLA. Amazon.com Inc. AMZN. Alphabet Inc. Google. Facebook Inc. FB. Microsoft Corporation, MSFT. NVIDIA Corporation, NVDA. Please note that this list is not exhaustive, and it is important to conduct thorough research and analysis before making any investment decisions. Can ETFs be also used for swing trading? ETFs, exchange-traded funds, can be used by swing traders as they offer a low-cost and efficient way to gain exposure to a particular market or sector. Swing traders can use ETFs to capture short-term price movements in the market and to diversify their portfolios. ETFs can be traded just like stocks, with prices quoted throughout the day and the ability to buy and sell shares at any time during market hours. This provides flexibility for swing traders to enter and exit positions quickly based on market movements. Swing traders can use ETFs to gain exposure to various sectors, such as technology, healthcare, energy, and more, depending on their trading strategy and outlook. Some popular ETFs for swing trading include SPDR S&P 500 ETF, SPY, Invesco QQQ ETF, QQQ, iShares Russell 2000 ETF, IWM, Financial Select Sector SPDR Fund, XLF, Energy Select Sector SPDR Fund, XLE. It's important for swing traders to conduct proper research and analysis before investing in any ETFs, just as they would with any other investment tool. This includes assessing the underlying assets, the fund's expense ratio, historical performance, and any potential risks or volatility. This concludes our sessions. In summary, we covered the basics of several types of investment vehicles including stocks, ETFs, mutual funds, and bonds. We discussed the definition of each investment vehicle and provided examples of their roles in a comprehensive investment portfolio. Moving forward, in our next video session, we'll dive into the practical side of investing by discussing how to set up your trading platform. We'll walk you through the process of selecting a trading platform that suits your needs and provide guidance on how to customize it for optimal performance. Additionally, we'll cover the various indicators that we'll be using for market analysis and research. These indicators are essential for making informed investment decisions, and we'll explain how to interpret them and use them to your advantage. By the end of this session, you'll have a solid understanding of how to set up your trading platform and use it effectively for market analysis and research. You'll be better equipped to make informed investment decisions that can help you achieve your financial goals. We hope you found this video session informative and helpful in understanding the basics of different investment vehicles. If you enjoyed this video, please consider giving us a thumbs up and subscribe to our channel for future video tutorials. By subscribing and hitting the notification bell, you'll be notified of our upcoming videos, including the next session where we will discuss how to set up your trading platform and use different indicators for market analysis and research. Thank you for watching, and we look forward to seeing you in the next session.